With Chapter 2, we're going to take a broad look at the determinants of interest rates. Just a list of this chapter's topics: suppliers and demanders of funds, how interest rates are determined, and the factors influencing rates, theories of the term structure, and the quantitative part, deriving forward rates. Nominal interest rates are ones you can observe, like the T-bill rate. They have two components: opportunity cost. All securities rates are dependent on the rates available on competing investments, the rate you could earn investing in something else. These rates will be a function of the underlying supply and demand of funds available. Adjustments for individual security characteristics would include default risk, maturity, liquidity risk, and payment terms. These are different for different securities, so the rates are going to be different. The loanable funds theory basically explains interest rates and their movements. In a very simple way, supply and demand from households, businesses, and governments, both of which supply and demand funds, make up the loanable funds theory. Think of interest rates as the cost of money. The price of money is determined by the intersection of the supply and demand curves as shown in the graph. And on the coming slides, we're going to look at the impact as supply and demand change. If you look at the top two graphs here, the Fed funds rate and the T-bill rates move pretty much together, as do the AAA-rated corporate debt and mortgage rates. Looking at funds supplied, households and financial businesses were the largest suppliers of funds. Businesses of both kinds were the largest demanders. On a net basis, households supply, businesses demand. So if households are the largest suppliers of funds, what determines their willingness to save or invest? If interest rates increase on investments, households are more likely to save or invest. More income and wealth, more savings and investing. Attitudes about saving versus borrowing. Risk perceptions. How risky is it to invest rather than spend? And immediate needs. If the funds are needed now, then saving and investing is not an option. Credit availability. If low-cost consumer credit is easily available, it decreases the need to save. Why save for a new big screen TV when Best Buy will finance it for you right now? Job security and soundness of resources. If you don't feel like your job is secure, you may be reluctant to borrow. Foreign fund suppliers examine the same factors as U.S. suppliers, except that they must also factor in expected changes in currency values, global interest rates, different tax rates, and sovereign risk. There's typically some built-in demand for U.S. investments, however, because the U.S. is considered a safe haven, meaning a country with relatively low political and economic risk and a stable currency. High levels of reserves are indicative of foreign central bank activity to limit the growth in the value of their currencies against the dollar. This may be done to stimulate their export sectors, or the dollars are often reinvested in the U.S., typically in our treasuries. This provides an additional source of financing to the U.S. and helps remove a market discipline from our own U.S. borrowers. Well, clearly, China is the biggest investor in the U.S., with over 5 times more than the next largest investor, Saudi Arabia. Looking at determinants of business demand for funds. When interest rates are high, firms will try to finance projects with retained earnings. When a company has a lot of potentially profitable projects, they may demand more funds. When the economy is growing, both households and businesses are confident and will demand more funds. While touted a lot in the press, debt held by the public is the number that affects the credit markets. Looking at these numbers, the compound growth from 2013 to 17 is about 4.33%. The projected growth, 2017 to 24, is a little over 4.5% a year, or 36% overall. The point is that this projected debt growth is unsustainable and will begin to curtail other necessary spending and growth. Let's go back and look at the supply and demand curve for funds. As shown, the equilibrium interest rate, E, is the intersection of the supply of funds curve and the demand for funds curve. On the next two slides, we'll look at each of these graphs separately. The increased supply of funds on the left, the increased demand for funds on the right. Looking at shifts in supply. As the supply of funds increases, interest rates decrease. With the decrease in rates, quantity demanded will increase and the equilibrium rate will decline. Basically, more product available, prices come down, demand can go up. Shifts in demand, the other side. If demand goes up, Rates will increase, the quantity demanded will go with it, and the equilibrium rate will shift up. Holding the supply of a product constant, if demand increases, prices go up. This table is a version of Table 2.2 in your text and details the impact on the supply of and demand for funds and interest rates from changes in various factors. Direct means if one goes up, so does the other, the blue cells. Inverse means they move in opposite direction, the slightly orange cells. If interest rates increase, then supply goes up, demand decreases, and the rates change directly. They go up. When wealth increases, supply increases with no evident impact on demand. Increased supply, rates change inversely. They go down. Increased risk causes supply to decline as investors are less willing to invest in riskier assets. Demand also declines as borrowers are less willing to borrow. With decreased supply, rates increase. Increased immediate spending needs causes supply to decline and rates to increase. Increased monetary expansion increases supply and inversely impacts rates. An improved economy affects both supply and demand and inversely affects rates. The final part of this table. Utility derived means your satisfaction or pleasure from buying something. As utility increases, the willingness to borrow increases. Supply decreases, demand increases, rates increase. Restrictive covenants means added restrictions put on borrowers. It could be points on a mortgage, higher down payment, more collateral, or bond covenants for business borrowers. Lack of restrictions is attractive and would encourage borrowing. Increased restricted covenants will decrease the demand for funds. An increase in taxes reduces the incentive to invest or save, but tax deductibility of interest by businesses increases demand. Foreign investors benefit from appreciation of their own currency, which would increase supply and lower domestic rates. And finally, expected inflation would decrease supply, as suppliers of funds will be repaid in dollars worth less, but borrowers would repay in dollars worth less, so demand increases and rates increase. Looking now at the determinants of interest rates for individual securities. We're going to look at each one of these elements individually on the following slides. The inflation premium is merely the percentage change in the consumer price index. The real risk-free rate, which is also frequently shown as R*, is defined by the Fisher effect, which says the real risk-free rate is equal to the observable nominal rate, I, minus the expected inflation premium. Diverting briefly to look at the CPI and the T-bill rate. The upper graph shows the T-bill rate as the dotted blue line and the CPI as the solid black line. The lower graph shows the result of applying the Fisher effect to find the real risk-free rate. Note how it changes the shape of the graph. Continuing with the determinants of interest rates. The default risk premium is represented as the difference between the yield on this security and that of a similar maturity treasury. The liquidity premium is added to account for securities, typically corporate bonds, which do not trade in an active market, are not liquid. Special provisions premium accounts for other features of the security. For a bond, this could include callability, convertibility, collateral, and a maturity premium. Longer-term securities carry a maturity premium for the risk involved in tying up investors' money for a longer period of time. Looking at default risk premiums over time, you can see here the spread between AAA rated debt and BAA rated debt. They move together, but notice that the lower rated debt moves more. This graph depicts the three possible shapes of the yield curve. Upward sloping is the most common. It implies longer-term rates are higher than short-term rates. The downward sloping curve is called inverted, and it implies the opposite, short-term rates higher than long-term rates. This would be unusual. The flat curve implies no difference based on maturity. Looking at theories related to the yield curve, the unbiased expectations theory states that long-term rates are geometric averages of current and future short-term rates. Unbiased expectations assumes no interest rate volatility. The rates used here should be zero couponed rates called spot rates. The equation at the top and the one at the bottom are the same. What the sigma is to addition, pi is to multiplication. We're using observable spot rates to imply a future rate, and the example is on the next slide. Using the given data, we can find the current implied 3-year rate now equal to 1.55%. Think about the logic here. We're looking for a 3-year rate now. If the 1-year rate now is 10%, the 1-year rate next year is minus 15, and the 1-year rate the year after is 12, then the product of those three, the cube root of that, must be the 3-year rate now per year. The liquidity premium theory assumes that investors overall prefer short-term liquid securities. Thus, as maturity increases, rates reflect an increasing liquidity premium. The revised geometric average formula incorporates these at each maturity level. As stated, positive liquidity premia assume that investors prefer short-term holdings to long-term holdings. Note that with the liquidity premium theory, the yield curve is always upward sloping and above the unbiased expectations curve. Another theory regarding the yield curve is the market segmentation theory. It assumes that investors have specific maturity preferences and they will not deviate unless there is a substantial premium to do so, meaning investors who prefer 10-year notes will not change and buy 30-year bonds unless the rates are compensating. Here comes the real quantitative part of Chapter 2, implied forward rates. As per the definition, a forward rate is an expected or implied rate on a short-term security originating in the future. It's implied based on observable spot rates, and we're going to see this on the following slides. This is example 2.4 in your text for reference. In it, we're given 4 observable spot rates, which we'll look at more closely on the next slide. Using those, we want to imply other short-term rates. We are given a 1-year rate beginning in year 1, 0.156%, a 2-year rate beginning in year 1, 0.305% per year, a 3-year rate beginning in year 1, 0.499% per year, and a 4-year rate starting in year 1, 0.753% per year. Let's look at a graphic to get a better idea of what the given data actually means. The 2-year rate beginning in year 1 of 0.305 means 0.305 per year for 2 years. The graphic details what we're looking for, the pink cells. Given a 1-year rate starting in year 1 and a 2-year rate starting in year 1, we can imply a 1-year rate starting in year 2, or 2-1. Simply put, the 1-year rate starting at year 1 times the 1-year rate starting at year 2 must equal the 2-year rate starting at year 1 squared. It's a 2-year rate. We'll follow the same methodology to find the other implied rates. While I'm showing these as R12 for simplicity, we always add 1 when multiplying and then subtract the 1 back out at the end. And on the next slide, we'll walk through this in more detail. The first part of the example is shown above. Given a 1-year rate starting at year 1 and a 2-year rate starting at year 1, we can imply the 1-year rate beginning at year 2, the blue cell. For computation, all rates are added to 1 and the 1 is subtracted out at the end. The logic is that to avoid an arbitrage opportunity, the product of the 2 1-year rates must equal the 2-year rate squared. To see this in Excel, you can click on the Excel icon. The second part of the example is shown above. Given a 2-year rate starting in year 1 and a 3-year rate starting at year 1, we can imply the 1-year rate beginning at year 3. Again, the blue cell. The logic is the same as with the 2 1-year rates. Now, this is not an easy concept to grasp. Even the author says in the instructor's manual that it's very confusing. I strongly suggest you work through these examples to feel more comfortable, and we'll work some problems in class. I'm going to stop here because the second part of this chapter is a time value of money review, and I want to put it in a separate recording.